I watched the entire 2022 ICT mentorship and took notes on it, and I'm going to summarize the key points of that model in this video. Let's start off with the basics of fair value gaps. There are two types, SIBIs and BISIs. Let's start off with the first one, which is a SIBI, and that is a sell-side imbalance, buy-side inefficiency fair value gap. It is a 3-candlestick pattern. You have candle number 1, 2, and 3. Between the low of candle number 1's wick and the high of candle number 3's wick, it creates this gap where it only trades with that body of candle number 2 through that area of price action. So it creates an imbalance because it only delivers to the downside. ICT talks about these areas acting as potential resistance. As we can see right here, it retests that area as resistance and heads lower. So this is what a bearish fair value gap looks like. Let's move on to a bullish one. This is a BISI, buy-side imbalance, sell-side inefficiency. It is again a 3-candlestick pattern. We have candle number 1, 2, and 3. Between the high of candle number 1's wick and the low of candle number 3's wick, it only trades to the upside on that candle number 2. So this creates an imbalance in the algorithm because it only delivers to the upside here. We could draw this little rectangle between candle number 1 and 3, and when price retests that area, that is a potential area for support. You could see it retested twice before continuing much higher. So the ICT 2022 model is based on fair value gaps, but there are other things that contribute to this model, such as the market structure shift, which is what we have right here. You can see that a low is in place. It rallies above that low. When that low gets taken out, ICT considers that as a market structure shift. When this happens, what we look for is within this price leg between this high and this low, we look for a fair value gap. So in a bearish example, we look for a market structure shift with a fair value gap within this range between this low and this high. So here's an example of that happening. You can see that we have a low in place. It created a high, then it created a lower low, taking out this low. Within the price leg between this low and this high, we do have a bearish fair value gap in here. You can see that price returned to it, retested it as real resistance, and then went lower. Now we could use the bullish fair value gap in the same exact way. So we have a high in place, then a low, and then that high gets taken out. This is our market structure shift. Between this high and this low, we look for a bullish fair value gap as price was displacing to the upside. You can see that we have the bullish fair value gap right here. So you can see price returns to it, accumulates in it as support before smart money pumps the price higher. So within this ICT 2022 model, it's important to have a market structure shift with a fair value gap, but there's one more thing that is a key contribution to this model, and that is that there is a liquidity grab before all of that happens. So if we go back to the bearish example, you can see before you get that market structure shift, it's important that an old high is taken out. So above old highs is considered buy-side liquidity. And the reason that is because retail traders typically trail their stops right above old highs. Those stop losses are categorized as buy stops. Smart money likes to hunt those buy stops so they could sell to buyers at a higher price. The point of this is that they have liquidity. So they're taking it above a high, getting liquidity, and then displacing price to the downside. Then it creates the market structure shift with the fair value gap. This SIBI fair value gap is the short entry here. Now same can apply to a bullish example. You can see that price takes out an old low, and old low is categorized as sell side liquidity according to ICT in the 2022 mentorship. The reason it's categorized as that is because beneath old lows, retail traders will typically trail their stop losses. And when they're long and they trail their stops beneath an old low, it's categorized as a sell stop because that's where they have to sell their long positions at. So retail takes it beneath old lows to buy from sellers at a lower price, then displaces price higher, creates the market structure shift with the fair value gap. Once it creates that fair value gap and it follows the other criteria, we have an ICT 2022 model. Before we do continue, if you guys would like my entire ICT 2022 mentorship notes, I will leave it in the second link down below for free. The first link is a link to my Discord, which you can get a 3-day free trial. I cover tons of educational ICT content in there, as well as calling price live on stocks, crypto, index, futures, and occasionally commodities and Forex. So if you guys are interested in that, make sure you check out the links down below. So far what we have is a liquidity grab, a market structure shift, and also a fair value gap. To add time into the picture now, we could look at kill zones. There are two different kill zones. We have the AM session and the PM session. The PM session is between 1:30 to 4 p.m. And if you're going to look at these kill zones, your chart has to be on New York local time. So you can go to the bottom corner down here and you could click on this and put your chart on New York. Then you can look at these kill zones. So these are time zones where we can be looking for these setups. So you can see that price was around that higher fair value gap, but it was really within this lower SIBI fair value gap during that kill zone. This was the short entry. Stop loss can be above candle number 2 of the fair value gap up here. You can see price displaced lower. So now if we take a look at the bullish example on ES, price was accumulating within the bullish fair value gap during the AM session kill zone, which is 8:30 to 11 a.m. You can see this was the opportunity to buy down here, and then price was just displacing higher pretty much the rest of the day so far. So the last thing I will add before I close this video out is we can mark out midnight and 8:30 New York local time, meaning you could draw out the opening price on this candle at midnight and also on the candle at 8:30. ICT also talks about the power of 3, that when we are expecting higher prices on a higher time frame, what will typically happen is when price is beneath midnight or 8:30, it is manipulation. So we get accumulation around it. When it's beneath these levels, it is just manipulation before we do see distribution towards that higher time frame target later in the day. As you can see for this example, price was beneath midnight. We have a liquidity grab by price taking out this old low. It takes out sell side liquidity, market structure shift, and it also has a fair value gap. This was the long entry, stop loss beneath this low right here, and then price just displaces higher the rest of the day. I can make a part 2 to this video covering more about targets, stop losses, and standard deviations. If you guys would like that, get this video to 75 likes and I will drop a part 2. Catch you guys later.